Greetings, everyone. Welcome to another episode of T.Gresh Realty. I am your real estate queen, Tanita Gresham. Today, we're going to be taking a tour on a 5-bedroom home, 4,069 square foot of space. And instead of me just going on talking about the house, you can see for yourself what the finishes look like, what the rooms look like. I want to get into some information that a lot of homeowners, especially first time homeowners, may not be privy to. And that is basically, why does your mortgage increase? Okay. Because I have seen a lot of videos on social media, specifically TikTok, Instagram, and YouTube, where homeowners have been complaining about regretting buying or purchasing a home. And I have to say this: home ownership is a mindset. All right. If you don't have the mindset for home ownership, then it may not be for you, and you may be better off renting or making whatever arrangements you need to make. But for those of you who are interested in home ownership, I would like to get into why your mortgage payment could increase and why your mortgage payment might potentially be more than your actual rent. Okay, because that can be the case in some instances. For me, that was the case. My mortgage payment ended up being more than my rent. And there are a couple of factors that plays into that. So let's get into the components of what a mortgage payment is comprised of. First, you have your principal. Now, this is going to be the actual amount that the house costs, okay? But now, on top of that, if you don't have the cash to purchase your home in cash, then you're going to have what's called interest. Everyone knows that a bank charges interest for them loaning you the money, okay? Most mortgages are between 15 or 30 years. 15 or 30 years. If your mortgage is 15 years, that means you would pay it off in about 15 years, then your interest rate is going to be lower, but still your mortgage payments will be higher because you're taking a large sum of money and condensing it into a shorter amount of time. I want you to think about your car payment. If you were to purchase a car and get a loan, you can have a loan on a car for 36 months, 48 months, 60 months, and up to 72 months. The longer it takes you to pay off that loan, the higher your interest rate will be, the lower your car payment is, okay? So it is the same thing when it comes to a home. If your mortgage is going to be a 15-year mortgage, which you can actually choose which one works best for you. 15-year mortgage will have lower interest with higher principal or a higher mortgage payment, and that is because you're paying off a large sum quicker. All right, a larger balance, you're paying it off a lot faster. So you're going to have a larger mortgage payment. If you stretch that loan out to double the 15 years, so you're stretching it out for 30 years, you will have more interest. You're going to pay a larger interest rate and you're going to have smaller mortgage payments. All right, that is the difference. Now let's get into PMI, which is called private mortgage insurance. This is what the mortgage company charges you to ensure that you make payments on your loan. And then there's mortgage insurance premium. Normally we see this on FHA loans, okay? Those are loans that are basically given by the federal government. And you have to meet certain criteria to obtain the FHA loan. We see more first-time home buyers that take on the FHA loans because there is a smaller down payment that is required up front. All right. Escrow is comprised of your insurance and taxes, everybody. And if you have never heard of the term escrow, I'm going over that with you now. So you have insurance and taxes that make up your mortgage payment as well. Now, let's get into the insurance. Everyone is required to have homeowners insurance on their home, and especially if you have a loan on your house, meaning you are still making payments to the bank for your house, the bank is going to require that you have mortgage insurance on your home, the same way that you do with a car. Say you did not purchase your car in cash, well, then that means the lien holder or the bank is going to require for you to have full coverage, meaning comprehension and collision coverage on your car. So you will also need to have insurance on your house, because if something were to happen to the house, if it were to get damaged, if you, whatever the case is, that bank wants to make sure that you have insurance on that property, okay? Because they're lending you money to purchase, so they want insurance on their property. And then taxes, all right? Everyone, unfortunately, in this country pays taxes. Even though I may not agree with it, there you will be paying real estate taxes. You would pay taxes on your land, even if you have paid for the land, even if you've already paid off your mortgage, even if you have already paid off your car. A lot of states still require you to pay personal property taxes for cars, and then for homes, you pay real estate taxes. All right, but you can write these things off on your income taxes at the end of the year when you file your taxes. Isn't that something? So, taxes are a thing that does take place when you purchase a home. You will be taxed. Real estate tax is very real. And what people don't understand, this is why we hear a lot of people complaining about they regret being a homeowner, they wish they had never purchased a home, is because their taxes may have increased because the value of their home may have increased. So this causes their taxes to go up. Also, insurance may have gone up on the home. If this is the case, then that means your mortgage payment may increase. A way that you can actually take care of this from, being an issue is you can actually pay more money into your escrow account to balance off that house payment, everybody. So say there is a shortage in your escrow account, which your mortgage lender, whoever services your mortgage, will send you some information and let you know how much of a shortage you have in your escrow account at the end of the year. And if there is a shortage, they will tell you that you can pay an extra $1,000 to take care of it. And that will allow your mortgage payment to stay the same. Okay. That will allow you to still pay the same amount that you were initially paying for your mortgage. Now, another thing that I want to talk about are the adjustable rate mortgages that a lot of people may or may not be privy to. And this actually is something that I would typically tell people to stay away from, especially if you don't understand it. The adjustable rate mortgage people refer to as ARMs, okay? Basically, this increases and it fluctuates as the market fluctuates. So there have been people that have gotten into an adjustable rate mortgage because they did not have a clear understanding or a clear conversation with the lender that provided them the loan to finance their home. What happens with an adjustable rate mortgage? Again, as the market fluctuates, so does your rate on your home. That means your mortgage payment can fluctuate as well. It can go up and it can also go down. In the cases where it goes up, people are not financially prepared for this drastic change, and you can be in a financial debacle if you do not understand what's going on with your mortgage. So, everybody, I would strongly suggest that you try to get into a fixed interest rate, meaning your interest rate stays the same for the life of your loan unless you refinance your home. And a lot of times people refinance so they can get a lower interest rate. That can take a couple of $100 off your mortgage payment, depending on circumstances in the market. Okay, that is something that I would highly suggest doing. Another thing about mortgages that people don't understand is the 2-for-1 buy down. If you've ever heard of that, it's a 2-for-1 buy down, and a lot of new construction communities offer this as a way to get into a home. What they do is say the interest rates right now are going for 6.75%, okay, which is pretty typical. I just spoke with a guy, a young man. Well, he's older now. He's retired. He was actually a teacher for 30 years, and back in the 80s and 90s, he said he purchased his first home at 12% interest. I've even heard of mortgages being at 20%. I spoke to a guy the other year that said mortgage rates had gotten up to like 19 and 20%. But guess what? People were still purchasing homes. So all this talk about, oh, I can't get into a home because it's 6 and 7%. Everybody, that is pretty typical and pretty average over the course of the last 30 years. Just FYI, in case you were not aware of it. People are still comparing interest rates to COVID prices, and those days are not very typical for what the country has been through. Okay. The 2-for-1 buy down is basically where you can get into a home at the lower interest rate, and each year your interest rate increase until it reaches the peak interest rate that is standard for the market, that basically you qualify for. So say your lender says, okay, your interest rate is going to be 6.75. So in year number 1, you might start off at 4.25%. At year number 2, you might go to 5.25%. At year number 3, you might go to 6%. And at year number 4, you might go up to 6.5% until you get to that 6.75%. Once you reach the 6.75%, that is when it caps out and it no longer increases. You are at the very highest end of what your mortgage rate will be. The reason that they do 2-for-1 buy downs is so that it makes it more comfortable for you financially to get into your home, and you can make the necessary adjustments as each year passes to get accustomed to what the mortgage rate is going to be. So always try to budget for the 6.5%. Don't budget for the 4.25, because that's just what you're getting into the home for. But just keep in mind that it will increase until it reaches 6.75, and then it's going to max out and it should not increase anymore. Always save your paperwork. Always have a hard copy and keep that in a safe where you can refer back to your paperwork in case you have questions for your lender. Another thing that people do not understand about mortgages is that your lender sometimes does not service your loan for the entire life of the loan. That means a lot of times lenders will get you, to the closing table, and after a year or two, they sell your loan to another lender. So that's why your lender may change. Who you make your payments to may change. This is why it's very important to keep copious records of your loan agreement and of your home mortgage payments. Okay. I hope this has been some helpful and useful information for anybody out there that may be thinking about home ownership. If you have questions or concerns and you would like a free consultation from your real estate queen, please reach out to 980-428-2333. My name is Tanita Gresham. Thank you so much for listening. Remember to always be the CEO of your financial future, that is creating economic ownership. You all, I am signing out.